Welcome to another edition of Community Capital Live. Very grateful I get to spend my time with you all today, and really looking forward to talking with Blake Jones of the Kachuwa Impact Fund based out of Colorado. Really innovative and interesting stuff that they're doing, and I think Blake has got a really good story that I'm excited to share with you guys, and a lot of knowledge that we can share with you all too, whether you're looking for alternative impact strategies for yourself or you're looking for alternative impact strategies for your whole community. That's really what we're here to talk about on Community Capital Live. This is the place to come to learn about how to invest your money, not just with the largest profit in mind or with Wall Street in mind, but with Main Street in mind and with impact in mind. So we focus both on place-based funds that really work to grow local economies. And we also focus on impact-based funds that are working to solve not only a market problem, but also a social problem in the process. So excited to get to dig in with that on that with Blake today. Um, I want to make sure first we shout out our partner organizations. Really, really grateful for this entire thing. It is a collaborative between several organizations and several publications that you want to be subscribed to, that you want to be a part of if you are interested in anything that we're talking about here today. The first one is Main Street Journal, which is the place to go for that place-based investing knowledge. Main Street Journal is one of the first things that I started reading and subscribing to when I first learned about local investing, and it's headed up by Michael Schuman, who's the author of several books on local investing, including "Put Your Money Where Your Life Is," which is his most recent book. So check out Michael's book, "Put Your Money Where Your Life Is," and subscribe to the Main Street Journal. Also, want to give a big shout out and thank you to Neighborhood Economics, who has really been the organization that has created the space for not only this program, but for people to come together, whether they are impact investors, whether they are social entrepreneurs, whether they are community leaders and faith leaders, to come together and share knowledge, share connections, and work together and start organizing. Recently, they held their most recent conference in Chicago back in September. Subscribe to Neighborhood Economics for the upcoming conferences and other events that they'll be hosting. It really is the meeting place for the solidarity economy. We also are partnered with Impact Alpha, which is the publication you want to be subscribed to and be a part of if you are looking for any impact investing, whether that's knowledge for yourself, for to be an investor, or whether it's just to learn the landscape better. That's really the Wall Street Journal for impact at Impact Alpha. So go ahead and subscribe there. And lastly, we'll throw out my show that was on Biz Radio US, Mindful Marketplace show, where we talked to people who are working in the solidarity economy on a bunch of levels, really trying to do basic education for people around worker ownership, around social enterprise, and around community investing. So that show has ended, but there's a lot of good stuff in the archives to listen to there that you can learn from as well. Okay, I think that's it for everyone. And oh, look at that. Exact perfect timing. I had just finished up my partners and was about to announce our panel today. Our panel today is me, mostly, and Nicole, who just joined us, is the other half of our panel today. Nicole, very grateful. Nicole from Equal Exchange. How are you doing today?
Great. Sorry to be late. Just
No,
coming from another meeting.
I'll
All
let you
good.
get set. I'm gonna talk to Blake for a minute and then I'll let you jump in whenever you want.
Great.
Okay. So Blake, yeah, tell us about the Kachuwa Fund. Actually, I was curious, how did you said you started actually in engineering and working in, energy like fossil fuels. How did you get to impact here?
Yeah, I graduated with an engineering degree and went to work right out of college for the oil and gas industry for a subsidiary of Halliburton and worked there for about 5 years and loved it. But I have an older brother who has helped mentor me in a lot of different ways. And he was an environmentalist. He's like, "What are you doing working in the oil and gas industry?" if you're so excited about energy, why don't you look at renewable energy? It's growing, technology is getting better. And so that's what I did. I switched into renewable energy and have been doing that for 25 years now. But I was um, kind of became an accidental entrepreneur about 20 years ago when I and two others started a solar company here in Colorado called Namaste Solar. And we thought, if we're going to start a company, we're not going to do it the way we had seen it done, which we had, misgivings about or concerns about. We thought we've got to prove there's a better way to do business than the conventional norm. Let's try to do something different. So we started it as employee owned, a democratic workplace, flat hierarchy, um, 100% transparency. Everybody knew each other's salaries, everything like that. And that experiment ended up being wonderfully successful. Now we definitely tried things out that didn't work, but overall that experiment was really successful. And Namaste Solar has been a wonderful experience in my life. Um, but one of the things I learned about being a part of Namaste Solar, we later converted to an employee-owned cooperative. I fell in love with employee ownership, with certified B corporations, with cooperatives. We spun out about 5 other cooperatives from Namaste Solar, and one of those is Kachuwa Impact Fund, which that's what I spend most of my time on today. We also spun out a purchasing cooperative called Amicus Solar Cooperative, a credit union called Clean Energy Credit Union, a resource sharing cooperative, and Kachuwa Impact Fund. But that's the short story of how I got here.
Yeah, and it looks like I just saw from a recent report, you guys now, the Kachuwa Impact Fund is up to over, is it 3.4 million in annual stock offering? So how long has it taken to have that kind of growth?
Yeah, more than 10 years for sure. And we are now, that's how much we raised this summer. Um,
Hmm.
we usually raise about 3 or 4 million a year. And now we have just over 30 million in capital that we've raised from our co-op members. And we've got about
Hmm.
315 co-op members. And then our portfolio is about 65 million in total assets. And the difference between those two is we've borrowed money. We have some real estate, so we've got mortgages for the real estate. But yeah, it's a now a sizable portfolio that the cooperative has of 65 million in total assets.
What was that initial goal of creating the fund? What was kind of the problem you guys saw, or what was the ecosystem you guys were trying to create?
Yep. So two main problems we were trying to solve. One of them is I learned firsthand at Namaste Solar that when you're a mission driven company, especially one that's unique, like in being employee owned or cooperative, or you don't want to follow the conventional playbook of growing as quickly as you can and selling. And by the way, if you take money from the conventional suspects, sorry, from the usual suspects like VC funds or even angel funding or private equity money, it kind of railroads you into that type of path where you've got to grow faster than you might otherwise want to, and you've got
Hmm.
to provide a liquidity event or an exit within a certain period of time, and then you lose control of your mission and the kind of impact that you're having. So we learned that we couldn't take money from the usual suspects, and we had to try to find impact investors who is what they're often called, who are willing to invest in us. And so part of the goal is to be a source of that type of capital. We want to provide patient, long-term, non-controlling, mission-aligned capital to organizations out there. And we loosely call them impact ventures. That could be nonprofits, it could be employee-owned companies, it could be cooperatives, certified B corporations, mission-driven companies. Provide them with that kind of capital so that they can focus on running their company the best way they see fit, pursuing their mission, pursuing impact instead of trying to grow faster than they'd otherwise like and finding a way to get acquired or exit so that they can give us our money back. So part of the problem was trying to provide more of that type of capital, be a source of more of that type of capital for impact ventures that are out there. The second part of it was, I think a lot of people think that, their only investment options are on Wall Street. And
Hmm.
if you've got, a conscience or you want to have some impact, you might look at, so-called socially responsible mutual funds. But when you look at the top 20 holdings, a lot of those socially responsible mutual funds, you're like, really, is this the best that's out there? So we wanted to provide some alternative to that that's on Main Street instead of Wall Street, but also that has really, really high impact. And in order to do that, we thought you've got to have a diversified portfolio. And that diversification that mutual funds often provide for people who invest in Wall Street was a key component. The diversification plus the 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 size and all being on Main Street. So everything that we invest in is a privately held company or a nonprofit or real estate.
Yeah, because I'm noticing you guys are talking, so with that diversity, you guys are talking about kind of having an asset mix of at least 60% real estate is what I'm seeing. I know that that can help with obviously stability, a little less risk on that side of things. But are you guys using like a diversified community investment fund to allow unaccredited, average, normal, everyday people to invest into the fund? Is that where that 60% comes from? How does that actually, or I want to make sure I understand if
Yep.
there, are you just having a larger accredited angel investors, or are people on the ground investing through that mechanism or something similar?
Yeah. I'll unpack a couple items in there. First, I see Brian Beckins on the call. I want to give a shout out to him because I read an article that he wrote. Gosh, this must have been 15 years ago, about maybe it was a precursor to diversified community investment fund. I don't think he called it that in the article, but it was just talking about how you can invest in neat things on Main Street. One of them is you can be a nonprofit. Another one was if you're more than 60% of your assets are something that aren't securities, they're not investments, and then you're not technically an investment fund. You're not you know governed by the Investment Act of 1940. To make a long story short, technically, Kachuwa is a real estate company, and we do some investing in private debt, private equity, other things on the side. But technically, we're a real estate company, and the one perspective on that, one measurement is more than 60% of our assets are real estate. So we kind of started, our first assets were real estate, and we were thinking of making some other investments on the side. And that article that Brian wrote was critical for us to realize, oh, we can do a whole lot more than this. And one thing to provide that diversified fund to impact investors, real estate is a great addition. So we've got commercial real estate, we've got affordable housing, we have private equity, we have private debt, we have revenue sharing agreements, we have all different kinds of things. And that's, I'd say we're kind of like a combination between a real estate investment trust, a REIT, and a
Hmm.
mutual fund, with some VC, with startup capital, and a whole bunch of other things. And that diversification is really good for our co-op members. They love that, especially for those of our members who are non-accredited investors. And I'd say out of our 310 members or so, we're just over 35% non-accredited investors. We have a
Hmm.
minimum investment amount of $5,000. We're trying to be as accessible and as welcoming and as friendly to non-accredited investors as possible. And we can talk more about that. But a big part of it is that non-accredited investors have a hard time participating in private offerings. You
Hmm.
usually have to be an accredited investor for most of the private offering exemptions to even participate. The minimum investment amount can sometimes be $25,000, $100,000, $250,000. So it's hard for them to invest. And then when they do invest, do you really want to have all your eggs in one basket by participating in one private offering for one company? We really like the idea of saying, no, when you join our cooperative, you're investing in this very diversified portfolio that has all those different asset classes that I'd mentioned earlier. Um, yeah, so that's some of the background on it.
What about from the perspective of the businesses or the other the groups that you're making your investments into? What I noticed that your themes of impact, you guys are covering a lot of stuff, environmental conservation and renewable energy, also things like B Corp and ownership, majority ownership by women or BIPOC, or employee ownership. I'll just finish them here. Cooperatives, democratic workplaces, love that stuff. Sustainable agriculture, social justice, community wealth building. I guess, do you have an example of what one of those playing out actually looked like coming from that, from that company perspective that works with you, your company partners? Yeah.
Yeah, and not to to just focus on Equal Exchange, but Equal Exchange is a great example of that. Equal Exchange was a role model for Namaste Solar in that they're, what is it, a 40, 50-year-old employee-owned cooperative that has been raising capital from impact investors by selling a class of non-voting preferred stock, really showing that it can be done, being a positive example, a wonderfully positive case study that not just influenced Namaste Solar, but was also the kind of thing that our co-op members love to invest in. So Equal Exchange, uh, we call it a double word score or a triple word score when something aligns with more than one of our 10 impact themes that you just listed. And Equal Exchange is it's employee owned and it's a cooperative, but they also sell primarily fair trade products. And so that aligns with multiple of our impact themes. And that's the kind of thing that our cooperative loves. There are, on our website, you can find our portfolio, but usually an impact venture will reach out to us and say, hey, we're raising money, we're interested, are we a good fit? And the first thing we look at is, do they align with one or more of our 10 impact themes? And if they do, we'll take a look. That's the very first filter, and we'll do normal underwriting on it. But they've got to have impact or alignment with one of our 10 impact themes. And sometimes a impact venture needs help by gaining control of their real estate destiny. They need help because the building that they've called home for a long time is about to be sold out from underneath them. If that happens, we'll buy that building for them and share ownership with them over the long run. Sometimes they want debt because they don't want to dilute their cap table. Sometimes they want equity. Sometimes they're selling convertible notes. Sometimes it's revenue sharing agreements. However it is that they're raising money, we're willing to provide capital in that format. It's really up to them.
So we got a good question in the chat. So is the fund itself a co-op, meaning to invest, you have to join the cooperative?
That's correct.
Okay.
Yep. So
And
we're
then, yeah,
a couple
finish.
things about our structure. Yeah, one is that mix. We're at least 60% real estate, and another is that we're structured as a cooperative. So in order to invest, you have to buy one share of Class A common stock, and that's $5,000 for a share. That's why that's our minimum investment. And then you can invest more if you want by buying a class of non-voting stock at $1 a share. You can invest as much as you want. You'll get a proportional financial return, but you won't get any additional vote. So that's one of the hallmarks of a cooperative,
Yep.
is one member, one vote. But we have a lot of people who have invested more than that, and that's great. They'll get a proportional financial return, but they won't get any additional control over the cooperative.
And you mentioned your efforts to try to make that as accessible as possible. What have you guys learned in your efforts to do that? Because I know that there's challenges associated with it. Why did you guys kind of land at that 5,000? And, what did you learn in that process for people who might be looking to set up some kind of structure for themselves in the future for their communities?
Yeah, the $5,000 is somewhat arbitrary. We picked something that is you know similar to the minimum investment amount at Namaste Solar and other cooperatives that we've seen. We don't want it to be too low because administratively, if we start right out of the gate with 2,000 members and a lot of them are investing $100 each, that can be administratively burdensome. We wanted to avoid that, but we didn't want it to be so high that it was a barrier to entry. So anyway, we kind of pinned the tail on the donkey at $5,000, and that's been pretty good so far. Um, we've learned that it is very difficult to be as inclusive and welcoming and friendly to non-accredited investors as we'd like. A big part of it is how you raise the money. We do a Reg D 506B private offering exemption, and that allows non-accredited investors, up to 35 non-accredited investors per offering, to invest, but they have to be quote unquote sophisticated. And usually most people meet that guideline for being sophisticated by having an investment advisor who helps them to evaluate the investment. That can kind of qualify you as sophisticated. Or if somebody has an MBA or CPA, or they're an entrepreneur, or they've raised money, or if they participate in other private offerings, they could be a sophisticated investor. But unfortunately, we do sometimes turn away non-accredited investors,
Mhm.
sadly, because they can't meet that test for being sophisticated enough to, I think that the words are like, to be able to evaluate the merits and the risks of the investment on their own.
Mhm.
And they may not be wealthy enough, or may not be able to afford having an investment advisor either. And so that is, we have room to improve. Now we could do crowdfunding, and crowdfunding is a wonderful new avenue for raising money,
Mhm.
but crowdfunding is very expensive. And so with our public offerings or direct public offerings, so we're still exploring those things, but it is that's still room for improvement for us. Another thing that we do is, I think a lot of funds structure themselves as partnerships, as LLCs, for the tax advantages. We are a cooperative corporation. Technically, we're double taxed, but when you're an LLC and you're a partnership, you have to provide K-1 tax forms every year. Those are they're much harder to generate. You're usually late. Uh, for someone to incorporate a K-1 tax form into their own tax returns, it's very difficult. In contrast to that, we have kind of foregone the tax advantages of being a partnership and instead are a cooperative corporation, because we can issue 1099 DIV or dividend tax forms. They're very easy to send out by the end of January. They're very easy to incorporate into your tax returns. And so that's another example of how we try to make ourselves a little more friendly to not just non-accredited investors, but accredited investors as well. Most people don't like K-1 tax forms at all. And DIV tax forms are much easier. So yeah, those are
Yeah.
some examples.
Yeah, absolutely. Nicole, what are you most curious about? What do you want to get
Yeah,
in
I
on?
mean, so much information
Yeah.
here, Blake. It's really great to have you here. And I think, Quechua Namaste and Quechua is a really amazing accomplishment. And I think, it's great for people to see like what the potential can be. I think sometimes in these groups with the community capital, it's like, how do you get started? How can people relate to this? And, sometimes I guess the real estate component is expensive, right? And it's sort of tying up money for a longer period of time. So like, how did you get started with that? Was it sort of the profitability of the solar business that allowed for that kind of capital generation? And obviously 60% of portfolio is relative. So you could, we had like the Vermont housing co-op here talking about their solidarity investment group that's bought a few properties. But the bridge from there to sort of the scale that you're operating at, might be helpful for folks to and it's a big tent, right? I mean, so it's great. It's not to say that people can't get there, but yeah, maybe something about the business that allowed for that. And are there some more high value businesses that allow for this kind of alternative
Yep.
versus like equal exchanges in the food business, right? So our margins typically are lower. It took us a while to get to where we are, but appreciate the shout out.
Yeah, yeah. I'll tell our story. And by the way, solar is a low margin business as well. It's
Right.
basically like
Okay. Good.
electrical contracting. But when we started Namaste Solar, and we're trying to get a loan from a bank, um, they looked at the three founders and said, you're a startup. You have no collateral, you have no track record. We're not really lending to the company. We're going to be, we need to see each of your personal financial statements. And I had just come
Wow.
back, from working in the Middle East, making good money in the oil and gas sector. But I had a house. I had a house in Boulder that was mostly paid off. And they've said, oh, you've got some collateral. We can lend to the company, but we're really going to be, Blake, you need to provide your personal guarantee. And for those
Wow.
of you who have started cooperatives, and I know it's hard for cooperatives to find loans that don't require personal guarantees, which is tough. It's one thing when you're a sole proprietor and you're providing your personal guarantee because all the risk, all the reward is on your shoulders. But when you're a cooperative and you're trying to distribute that, it's very, very tough. But to make a long story short, we found a building that was going to be a great home for Namaste Solar. And the bank said something similar, like, well, you want to buy this building, we still need Blake's, personal guarantee. And well, that's kind of antithetical to what we're trying to do as a cooperative. We want the co-op to buy it. I said, well, why don't you, Blake's taking extra risk. How about we do this? We're going to have Blake buy the building, and then he can, you know, charge below market rent if he wants to Namaste Solar, because he's the one really taking all the risk here. And we said, well, we don't like that at all, but we really want that building. So, okay, that was the first asset that ultimately became part of Kachuwa that we bought, 20 years ago, back in 2005. And so it started with a real estate purchase that was, a small office building, but we still own that asset today. And it just kind of snowballed gradually from there. So I think part of our story, while we want it to be as replicable as possible, kind of like equal exchange, the one of the lessons learned and how we did it is that it was gradual. It snowballed over a very long period of time. And you know we can talk later, but and I can speculate about that, but we did it over a really long period of time. So it started with that one particular asset. I was CEO of Namaste Solar and we were raising money. We raised, $5 million over two offerings from like 125 different impact investors. I would interview each of them. Are you sure, you understand what you're getting into? We pay a 6.5% target dividend every year. There's no capital gain. It's fixed. Are you sure? Yes, we're sure. And I'd say, wow, that's so inspiring. Thank you so much for wanting to invest in us. Why do you want to invest in us? Well, we want to invest in you because you're an employee-owned cooperative, because you're a certified B Corp. And I was just so inspired by their stories. And I'd ask, well, what else are you invested in? And they would tell me what else they're invested in. Oftentimes it was equal exchange, and it was another cooperative called, Organic Valley, and it was all these other things. And from all those conversations, I was inspired to say, well, I'm going to take my money out of Wall Street, and I want to do like what they've done. And so over the course of the next 10 to 15 years, I was making investments in companies that I would meet at cooperative conferences, at NCEO, the National Center for Employee Ownership conferences, at the Certified B Corp conferences and gatherings. I was in a CEO group here in Colorado with other, impactful companies. And hey, I'm raising money. Sure, I would love to invest. And so over the course of 10 or 15 years, I then had this personal portfolio that included that building we bought for Namaste Solar, but also all these other neat investments. And then friends, family, and colleagues started saying, wow, how did you, that is such a cool portfolio. That's so exciting. How did you find those opportunities? How did you do that? I would like to do that too, but I don't know how. I don't have very much money, and or I'm not an accredited investor, so I couldn't participate in those private offerings anyway. Can we just piggyback on what you were doing? And that's where I got the idea. Since we love cooperatives, we're like, well, let's do this as a cooperative. And so we converted my personal portfolio, which was relatively small, but still, had enough critical mass to be sizable. We converted it into a cooperative. And then now 8 years later, it is, you know, snowballed much more quickly because we're adding new members to the cooperative. Their money is joining all the other members' money, and the portfolio is now 65 million in assets. So sorry, that's kind of the origin story, but it was it took time, and I think that slower, gradual process really helped out a lot with how we did it. And as Joel mentioned earlier, we raised just over 3 million in this year's offering. We do an annual membership drive, an annual offering, and usually we raise 3 to 5 million a year. And so that's kind of the growth rate of the portfolio, is bringing on 3 to 5 million in new capital. Sometimes we'll borrow some money when we're buying real estate. We'll get a loan or a mortgage for it. But I think that slow and steady growth has served us well. And by the way, Kachuwa means tortoise, so slow and steady is part of what we're trying to do anyway. Not just with how we grow, but also with um, investing in our investees and letting them know we're patient. We're in this for the long run. You don't need to grow super fast. We're here to help you pursue your mission.
And those investees investing back in the business also, which is a form of, worker ownership. And at Equal Exchange, part of our patronage is invested back in the company. And so we're financing some of our own. Yeah, it really is a beautiful model, because it is slow, but also when you're intentional from the beginning that that's where you're headed, I think you can make decisions accordingly, versus sometimes successful businesses transitioning to a co-op later and the employees needing to buy it is just so unrealistic, so it's really nice to hear how you've been able to marry, a couple of those concepts together, and also get this diversified capital thing off to a jump start, even in a slow growth. All these different businesses that are associated add excitement, diversity, protection, all that stuff, and the ability to replicate this through other mechanisms. So thank you for explaining that. That was a part of the origin story I was unclear on. So really helpful. I know we also have a bunch of questions in the
Yeah,
chat. So Joel, I don't know where you think it's great to have so many people
we
participating. So
do.
I want to be able to get to some of the questions.
Yeah, me too. And while I'm gonna kind of go through these and start. And if anyone can unmute, I'll call on you to just be able to ask your question directly. But I'm curious because you said there's like 5 other co-ops or so that are all a part of this, mini Madrigon, as Lonnie said earlier, right? Uh, I'm curious about the interplay as far as, are they serving each other's purposes in this way? Is it creating, like, does the fund funding other things within the overall picture? I'm curious what that interplay sort of looks like between the fund and the other entities that you have, the other co-ops.
By design, there's cooperation among them, and there's a little bit of overlap, but we also didn't want too much overlap, because if any one of the cooperatives fail, we didn't want them all to fail. So
Hmm.
intentionally, we wanted them to be self-sufficient, independent. But the overlap, of course, is fantastic. And for the cooperative nerds among us, anytime cooperatives can cooperate with other cooperatives, that's a wonderful thing. So, for example, one of the co-ops that we spun out of Namaste Solar is called Amicus Solar Cooperative. It's a purchasing cooperative. It's kind of like the Ace Hardware or the True Value Hardware of solar installation companies. And there are about 80 or more, almost all independently owned solar companies, kind of like the Namaste Solar is to Colorado, to those other 80 companies are to other states around the country. And we also have one in Puerto Rico and Canada. But they pool their purchasing power in order to get better terms on solar panels and solar equipment to try to level the playing field with a lot of the big publicly traded national solar companies and keep those independently owned solar companies able to compete with them. But Kachuwa has provided loans or equity or purchased a building in cooperation with some of those member companies of Amicus Solar Cooperative. So not all of them. All the Amicus member companies are able to, survive on their own and find capital from elsewhere too. But we're one of those sources of friendly, controlling mission-aligned capital. That's one example. Another example would be Clean Energy Credit Union. That's the credit union that we started with the help of multiple volunteers from the Amicus network. Kachuwa Impact Fund likes to do its banking there, and have its deposits there with Clean Energy Credit Union as one small example. And then another one might be Namaste Solar. Kachuwa Impact Fund still co-owns one of the buildings with Namaste Solar and has purchased some of Namaste Solar's non-voting class of preferred stock. So little bits of overlap between them, but a very small percentage of each of their business or sources of capital.
I think we're good. Okay. Yeah, no, appreciate that. All right, I'm gonna go ahead and call on Benjamin. Benjamin Tsai. Are you able to unmute?
Yeah, hey Blake.
Hey, Benjamin.
See you again. Kind of a co-op nerd question, but just curious, in Minnesota, we are doing a few real estate investment co-ops and similar to what you're doing, but smaller. And our state statute delineates between patron members and non-patron members. The patron members in our cases are typically like tenants of the co-op, and non-patron members are like the investors. Do you all have patron members, and do you treat them, do you treat them much differently?
Yeah, I think we put all of our members in one single category. We do consider them patron members. When we pay dividends, we call them patronage dividends, which for co-op nerds among us, recognize that term, but patronage dividends. However, we've been very, very conservative from a kind of a legal perspective that when we do private offerings, and by the way, our members are from all across the United States, so it's not focused on one state. A lot of cooperative state statutes allow you to raise money more easily from if the co-op members are based in your state, but we want them to be from all over the country. That's one issue. Another one is when we pay patronage dividends for many cooperatives, you can have those patronage dividends qualify with subchapter T of the Internal Revenue Code. Kind of like S corporations that abide by subchapter S. I guess you could call co-ops in some cases T corporations, but we have been very conservative about and we have not tried to get that tax advantage for our co-op, whereby the patronage dividends are tax deductible to the co-op, so it's single taxed instead of double taxed. We're incurring that double tax in order to be conservative. We're contemplating requesting a private letter ruling to see if our patronage dividends can qualify under subchapter T. We have not chosen to do that yet. And in the meantime, we're just going to take the most conservative route with it. I think one of the reasons why we're not sure is just an investment cooperative where people are kind of patronizing the cooperative with their dollars is new territory. It's not selling eggs or gallons of milk or, working a certain number of hours or deposit dollars in your credit union or all the other ways that are, kind of tried and true with other types of cooperatives. With an investment cooperative, it's different. We do have lots of other ways in which our patronage dividends are calculated in a very cooperative way. We think we make a really strong case for it, but I couldn't understand how someone would be skeptical about, wait a minute, how do we prevent, regular investment funds from just trying to call themselves cooperatives and paying patronage dividends in order to have them be tax deductible. So we're taking a very conservative approach on all of these co-op nerd wonky issues.
Awesome. Thanks. And I gotta run, but thank you so much for your time. I got another meeting, so I'll see y'all.
Yeah. Thanks, Ben. Appreciate it.
Yeah.
And similarly, along with kind of the ecosystem and everything, Jen had a question that I think is pertinent to what you were just saying. Jen.
Yeah, and you answered this all part of it already, but just, if there were any other reasons why you decided to start a credit union, you mentioned, which is a really great reason, so you could deposit some of your funds that you have, but the other part was I was just curious if it was some kind of mechanism to bringing more, everyday investors into the realm, if that was an intentional idea when you started it.
It was definitely a separate entity with its own origin story. But I guess the one similarity is that Clean Energy Credit Union, the dozen of us or so who co-founded it, it was kind of for similar reasons. There was like a supply side and a demand side. We were seeing that a lot of people who wanted to buy solar systems or who wanted to buy heat pumps or get other green home improvements, they couldn't afford them. They didn't have the upfront money to pay for a $20,000 heat pump or a $30,000 solar system. And most banks and credit unions did not want to offer them loans. So we knocked on the doors of 24 of them saying, hey, this is a growing market. This is a wonderful new asset class for you. They help people save money on their utility bills, and sometimes their savings is higher than what the debt service is going to be. Like, this is a fantastic opportunity. Why don't you provide loans? They're like, no, we can offer them a home equity line of credit or a second mortgage. And I thought, well, that's not what they want. They want like a standalone loan for it. They didn't want to do it. So we thought, well, we'll do it ourselves, and we started a credit union to provide really good loans for only for clean energy related products and services. So you can get an auto loan, a vehicle loan, for example, from Clean Energy Credit Union, but it has to be an electric vehicle, for example, or a plug-in. Then the other half of it was like me, after my journey, wanting to be a conscious consumer, wanting to work at a place that was having impact, wanting to do impact investing, where invested my dollars that have impact. What were the next frontier? Well, what about impact banking? Where can I do my banking so that it's going to have a positive impact and not accidentally invest in fossil fuels, things like that. There aren't a lot of choices out there. Sure, there are a lot of credit unions, but a lot of credit unions have forgotten that they're cooperatives and just do normal loans. There are some certified B Corp banks out there, like shout out to Amalgamated Bank, which is Kachuwa Impact Fund's primary bank. They do great stuff. But the neat thing about Clean Energy Credit Union is when you deposit your dollars there, you have your checking account, your money market account there, or buy a CD. The money is federally insured just like it would be by Wells Fargo or Bank of America, but the money is only used to help another co-op member, another credit union member, to get a loan for an electric vehicle or to put solar panels on their roof or to get a heat pump or to do some other kind of a green home improvement. And that's a really high level of purity. I say that with my nose in the air. For people who are looking for that kind of high purity of what's going to happen to my dollars, that's been very attractive to a lot of people who want to join Clean Energy Credit Union and deposit their dollars there. So I'd say maybe in that regard, there's a twofold mission to Clean Energy Credit Union, and in that way, it's similar to Kachuwa, which also has that twofold mission to help the impact ventures, but also to help investors to have that kind of high purity portfolio to invest in.
Yeah, I
That's
love that.
awesome. Thank you.
Yeah, it reminds there's a credit union in my area down here in North Carolina, Self-Help Credit Union, that does a similar thing, but a lot of their mission is around providing mortgages to families who wouldn't be able to get them at a private bank. So they're tackling the housing issue alongside, giving a rate of return on their CDs. And so, yeah, I think that's sometimes the simple answers get a little overlooked, and a credit union is a really great tool for these ecosystems that are really important. So yeah, appreciate that. Next we had, I know John, I don't know if he can, I know he said he's overseas tuning in, which is awesome. Thanks for joining us at, I don't know what time it is, maybe 10 o'clock at night. Are you able to unmute, or I can read if I don't hear a response from you in a few seconds, I'll read your question here. All right. John asks, have you considered the internet public offering shareholder membership or shareholdership model like the fund Rise uses for your venture impact portfolio? He said he's dialing in from Portugal and wondering if you could share what the typical or the main categories of your for your cooperative shareholders. He said he's interested to know the cultural openness to the cooperative movement vis-a-vis private equity culture has impacted adherence is the question.
I didn't find familiar the term that was used about the type of the way we're raising money. So the short answer is no. I have heard of Fundrise though. I think I've heard like, commercials for them. So
Mhm.
I'm going to look that up and try to educate myself on how it is that they're raising money. But the short answer is no, we haven't considered it. I think maybe out of ignorance, we're not aware of how Fundrise raise money or other alternatives. And then in terms of our co-op members, again, there's between 310, 315 of them now. Most of them are individuals, but we do have some private family foundations, some nonprofits, some companies, trusts, and out of the 30 million or so, I'd say you can calculate the average is, but I think the median investment amount is somewhere around 25 to $30,000. So we do have some high net worth individuals. We do have some foundations, some organizations that have invested, larger amounts, 6, even 7-digit numbers. But we have a lot of our members who have invested $5,000, $10,000, $25,000, $50,000. And we've had a lot of our co-op members too make follow-on investments, which is fantastic. That they joined the co-op, they got to know it, and they said, you know what, we've made a little more money, now we want to invest some more in the co-op, and we welcome that too. But it's a nice diversity of co-op member categories and types. And again, I think I mentioned this earlier, but around 35% of our co-op members are non-accredited. There's one other category that's inspiring to mention of our co-op members. So we have multiple investment clubs that are members of the co-op. So if you're not familiar with investment clubs, look it up. They're a neat way to kind of qualify as an accredited investor, even if all the club members are not accredited investors. But we have multiple clubs that have invested in us, sometimes $5,000, $10,000. So that's another way for multiple people to pool their money together to make investments to diversify things further. But very inspiring those investment funds that have joined the co-op.
Yeah,
Excuse me, those investment clubs.
I gotcha. I want to let Lonnie, if she's here. I know had a couple questions throughout. Lonnie, are
I'm
you able
here.
to unmute?
Yeah, I'm here. I'm not sure which question you want me to ask. I've been sort of throwing them. He's answered that it was national. Blake, registering in every state is a very costly thing. How did you begin? Because I'm looking to shape my very first fund. So,
And what do you mean by register in every state?
well, in order to be able to accept investors, beyond Colorado,
Yep.
you had to then register in each state that you wanted to invite investors in, correct?
Yep. And I'm not a securities attorney.
That's why we have Brian.
I was about to say that's who our securities attorney is. He's on the call. But my layperson's understanding of it is when we do a regulation D, 506B private offering, if we get an investor from, let's say, the state of Missouri, where I'm from, we then need to do, I think they're called blue sky registration in that state of Missouri. And you file a Form D, when you open your offering, and then if you get an investor from the state of Illinois, then you need to kind of file or register, which is pretty easy to do, I think, with the state of Illinois. And then you get your next investor is from the state of Texas. You need to do the same thing in Texas. But if you don't get an investor from Idaho, then you don't do that in Idaho. So each of our annual membership drives or each of our annual offerings, we're only kind of doing those blue sky registrations in the states where we get a co-op member investing from, if that makes sense.
Gotcha.
And we have found that to be, and we've done it so many times that maybe we've gotten used to it or we've developed an efficient way to do it. But I don't think it's that onerous. We know some companies that just have their attorneys take care of it or they outsource it. That's fine too. But we've learned that it's not that difficult to do.
And you've never used a crowdfunding
No, we've
form.
looked into it, but
You find it costly because of the intermediary?
well, I think that, yes, I think you have to use an intermediary is my
Yeah.
understanding. Again, this is a
Yeah.
layperson's understanding. And usually, I think the prices we were quoted 7, 8, 9% of the proceeds.
Okay.
And that's just really expensive. And, we haven't talked about this yet, but our co-op, we have 90 to 95 assets. in our portfolio. So a
Mhm.
lot of different assets. Some of them we've invested as little as $15,000. You know, a solidarity investment in a fellow co-op are some of those small ones, and we have some real estate assets that are multiple millions of dollars and everything in between. A lot of different assets. Where was I going with that?
Something about crowdfunding?
Uh, yes, we're aiming. Thank you.
You're welcome.
We're aiming for a whole portfolio return of around 5.5 to 8% on average per year over the long run. And we set expectations with our co-op members that it's going to look like a sawtooth. There are going to be years in which we might pay a 2% dividend, and there'll be another year in which we pay a 5% dividend. Like last year, it was 5%. Because we're patient investors, we're not pressuring any of our investees to pursue a liquidity event. Now, some of our investees, like Equal Exchange, we hope that they're paying an annual dividend every year. We have loans to CDFIs, we have loans to nonprofits, we have other preferred stock investments in cooperatives that do pay dividends or interest payments. And then of course our real estate, we have leases with our tenant partners. They pay rent. We can count on that type of income. But another category of our income is capital gains. And
Yeah.
there are a lot of our investments that are, where we are counting on a capital gain. Like for example, if we someday sell the real estate, we will not sell the real estate until our tenant partner is ready to move out, but there'll be a capital gain. We don't know, we can't predict when we'll recognize or realize those capital gains. And so those might be the teeth
The
and the
high
saw
point.
teeth, you have the high points.
Yeah.
So
Yeah.
over the long run, we're aiming for between 5.5 to 8%. Now we consider that to be, it's not an extractive return, it's a reasonable return. It's not a philanthropic return. Some of the loans we do to CDFIs might be, only earning 2 or 3%. But then we also have investments in startups or even VC funds, which might be paying double-digit percentages. We like that diversification, that diversification, and all together the portfolio return, that's what we're aiming for.
That
So if you're going to
answers. Yeah,
so if
no,
you're
go
going
ahead.
to pay
Finish.
7 or 8% in crowdfunding, and make a long story short, that's an expensive thing. We're
That's an
trying to keep our
expensive
overhead
piece.
really low. Yeah.
And I think you've answered my final question, which is similar to what Tom, hey Tom, Greco asked about risk and how you protect your investors is because this is so diversified.
That's right. We have a
Yep.
lot of different types of investments. We also have, our board, we don't have any employees, by the way. We are kind of, I would say, volunteer led, although our co-op members have agreed to pay $100 per meeting honorarium to we have 5 people on our board of directors and we have 3 on our board of advisors. So the 8 of us co-manage the cooperative, $100 honorarium per meeting. So in some ways that is us subsidizing the cooperative until it reaches enough scale to be able to, for it to make sense to justify staff.
Yeah.
And that is where we plan on going. We see this in the future as it's larger, being managed by staff. The board becomes a true governing board. But until we get there, we don't want to burden the cooperative with overhead until we can prove the concept and, gain credibility and set a more positive example. But yeah, we're very conscious of not adding too much overhead to the co-op. And by the way, all 8 of us that co-manage it, all of our time does not add up to a full-time equivalent, which is
Wow.
great. We have found a really efficient way to manage these 90 to 95 assets. And a lot of it is through taking a page out of the playbook of shared ownership. And I'll give one example. When we buy a building, we don't go out looking for a building to buy. It's usually an impact venture that comes to us and says, we need help gaining control of our real estate destiny. A good example is Village Institute here in Denver. It's a nonprofit. They had found the perfect home for their nonprofit. They help refugee and immigrant families settle into the Denver area. But the building owner wanted to sell it. And they didn't want it to be sold out from underneath them. It was a gentrifying neighborhood. They were worried about losing it. And they're like, we can't afford to buy it. We always tell them plan A is try to buy it yourself.
Yeah.
If you can't buy it yourself, we can help you buy it. And we provided 100% of the capital to purchase the building. We weren't able to qualify for a mortgage because it was a relatively new nonprofit, but we had the cash to be able to do so. And then over time, we're going to share ownership with them for helping us to manage the building. So they're in that building day in and day out. So if there are maintenance issues, they're the first line of defense for addressing them. Now we could
Sure.
hire a property manager, and through what's called a triple net lease, we would just
Yep.
pass through the costs of project management to them. But our tenant partners like being able to self-perform property management because they save money on it.
Sure.
And basically by performing those types of services, helping us to manage the building, manage the LLC that owns it, do the bookkeeping, they're earning sweat equity in that building over time. And it means that we don't have to have as much time and energy input
Yeah.
or the administrative
Yeah.
burden on our side. And so that's one example of how we can manage this portfolio that's 65 million in assets and 90 to 95 assets with a team of people that doesn't add up to a full-time equivalent.
Lovely. Thank you. Thank you. It sounds very similar. Also, do you know the CAST program in San Francisco that works
don't.
specifically for helping artists buy buildings in very expensive San Francisco with a partial ownership? It sounds very close. Lovely. Thank you, Blake.
Awesome. And I wanted to give Thomas a chance to ask if he had anything outside I'm not sure if felt your question had been answered or if there's anything outside of there, Thomas.
Well, yeah, I would like to add on to that to ask the same question about the credit union that you've started. What has been your default rate? You seem to be heavily invested in green energy. Do you see any risks in that realm?
Uh, and by the way, the National Credit Union Administration, the NCUA, the regulators, when we were trying to get our federal charter, it took us 3 years to get a federal charter. It's very difficult to start a credit union, unfortunately. They saw risk in it. They were worried about concentration risk. But when we explained to them that, yes, even though everything we do has a clean energy or energy efficiency theme, it spans a bunch of different asset classes. So we're doing auto loans, we're doing consumer loans, home improvement loans, electric bike loans. We're just now getting into commercial loans and into uh, residential mortgages. They all have a clean energy saving theme or energy efficiency theme. But once the regulators heard that, oh, actually though, what they see is, oh, we see auto loans and we see, um, home improvement loans and we see mortgages. They kind of didn't care as much about the clean energy theme, the thematic consistency among them. They were just happy to see that there were a bunch of different asset classes. So I hope that answers your question, Thomas. That's where the diversification in clean energy credit union comes from.
To add on to that, Blake, if you don't mind, what kind of return is your credit union able to offer to members?
So I would recommend going to the website and you'll see the rate sheet there. It's different for the checking account, for the money market account, and CDs of different terms. But
Yeah.
our goal at the credit union is to provide kind of middle of the road interest rates on the deposits, and maybe
Oh, great.
higher rates on the checking accounts. Really trying to help out people who use a checking account and a debit card, or also have a loan with us. There's a way you can qualify for like a 3.5% rate on checking account, but it's all on the term sheet on the website. And then we provide the very lowest rates on our loan side. Part of the way we can do that is because we're online only. We don't have brick and mortar branches. Brick and mortar branches are very expensive, add a lot of overhead for any bank or credit union. We kind of started as a 21st century financial institution, as I like to say, much cheaper, that we're not handling cash. We're not, dealing with branches. But by the way, because we're a co-op, we can use the co-op network of credit unions. So if someone really needs to use an ATM machine or really wants to go and talk to a teller, they can go into a co-op branch and say, I'm a member of Clean Energy Credit Union. I need help, and they can do it, and it's no charge to our member. That's another way of which cooperatives, cooperate together, is by kind of using different credit unions, allowing their members to use each other's ATM machines and branches. But anyway, sorry, that was a tangent. That savings and overhead allows us to provide really, really good loan rates. Now, you might find at Ally Bank or an Alliant Credit Union, another online financial institution, typically what they'll do if they're online only is they'll provide really high deposit rates, but normal loan rates. We did it the other way around. We're just going to provide normal deposit rates, but part of our mission is to try to help as many people as possible get behind the wheel of an electric vehicle, even if it's a little bit more expensive than a combustion engine vehicle. And by the way, we're a Clean Energy Credit Union, is a low income designated credit union, which means more than half of our members are low income. And that's our biggest audience that we're trying to reach, is that we think clean energy projects are of the most benefit to low income folks, because oftentimes these, a loan to get a heat pump can be cash flow positive. You're saving more money on your utility bills than it takes to service your debt. That's a great community wealth building tool, and something that our default rate on, I think we've done over 14,000 loans totaling over 270 million at Clean Energy Credit Union. And we have a 0.01% default rate. It's incredibly low, in part because of that reason.
Thanks for your detailed answer and for your great work.
Yeah, I love opening kind of our thinking on those kinds of things that yeah, actually saving money on your bills can be an ROI. You know, paying off debt and not being charged interest is an ROI. A lot of people aren't thinking about that way. We have one more hand up, so we'll Sam, go ahead and yeah, ask away.
Yeah, thank you so much. I wonder if this camera's working. Pardon me if not. I'll just get right to it. Yeah, thank you so much, Blake. This is really wonderful. And you know, getting into the intricacies on the solar side, I mean, I'm in the DC area and do local renewable advocacy, particularly focused on community sufficiency. And one of the challenges that we're running into with data center rollouts is, especially in marginalized communities, they can have rooftop solar, but that's all grid tied. So when we have these rolling blackouts coming in summer 2026, like local policymakers are getting warned about, they have, you know, solar on the roofs, but they're still losing power. And now you're talking about poorly wrapped homes, poorly insulated homes that are fully dependent on electricity that have none of it in these heat waves and these cold snaps. And so these are conversations that that we've had with, you know, local municipal folks and environmental agencies and things like that. And there's nonprofits doing really interesting work around not necessarily seeing the answer to that as battery storage, but also things like, you know, direct solar and community solar hubs and things like that, a little bit of a different way of getting to resilience. I was just wondering if there's a way to share this in conversation with kind of, you know, the folks who are doing this type of lending, or to bring this type of work or perspective into the opportunities that they're seeing. And if so, kind of what are the avenues to have those conversations?
Uh, I I'm not entirely sure, but I'll just give some examples. You know, Clean Edge Credit Union does lots of green home improvement loans. So insulation is not as sexy as a heat pump or solar panels on your roof, but insulation and, you know, buying new windows. There's a lot of windows out there that are still single pane windows with metal frames. You know, sometimes that's where your best ROI comes from, and yeah, insulating your home is a good first place to start. We're seeing more and more people get batteries. Sometimes, you know, batteries to tack onto the solar system that they bought a few years ago, or they're getting solar plus batteries, especially in Texas and Florida and California, where there are a lot more brownouts and blackouts, and the cost of batteries is coming down. It's following a similar trajectory that solar did, and electric vehicles and lithium ion batteries. You know, the cost is coming down. So I think you're going to see big cost downward curve for batteries. And then for community solar gardens, you know, that doesn't help keep the lights on either, but it's a way for a renter or someone who lives in an apartment building, or, you know, a condo building, or doesn't has a shaded roof, for them to get solar too. You know, we've experimented and started offering loans for people to buy a subscription into a community solar garden or a community solar project. And some of those are being organized as cooperatives, which is really fun to see. Um, so Clean Edge Canadian is trying to be at the forefront of helping to finance those things. But we're also can't be as innovative as we'd like, because we have to convince the regulators that what we're doing, they think that we're just doing the craziest things, and constantly asking them to do more crazy things every year. But that's part of our goal. And once we prove the concept, then it normalizes it, and hopefully, you know, we'll set a positive example for the other 4,500 credit unions that are out there. And so far, so good.
Awesome. Thank you. Well, thank you guys all for taking the time to be here with us today. There's more Community Capital Live coming up. Check in on the Main Street Journal, especially for the upcoming events. But Jen, do we know what's our next one coming up, so everyone can make sure to tune in for that?
Yeah, on November 5th at 2 o'clock Eastern time, we have Ryan Anderson of Steward. So he's talking about community capital in terms of regenerative agriculture.
Excellent. That sounds like an excellent topic.
Yeah,
All right, we'll
Blake,
make sure
I
to
just want to say thank you. I mean, honestly, like I think for everybody that's here and hearing, and these episodes are taped, also are recorded. So, you know, they really are a resource. And I think just your last statement really summed it up, right? I mean, you're sort of the vanguard for this. And then the hope is people can keep adapting these, but between all these different businesses and really what you've managed to build is quite extraordinary and really inspiring. And it's really great to have you here talking about it. Thanks for your time.
Thanks. And I do want to give a a plug for your library is fantastic. I really enjoyed going to the library and seeing you've already interviewed multiple other investment cooperatives and real estate cooperatives, and it was fun to be able to see some of those cooperatives. We give us so much inspiration and wonderful ideas, and happy to see that you're highlighting all of them because they're all doing it slightly differently, but hopefully we're all providing some positive examples and that'll encourage replication. And we want to make this ecosystem a lot bigger. So thank you all for doing what you're doing.
Yeah, that was the whole purpose of this when we started talking about it back almost 2 years ago now. Originally, was there's no real archive, there's no database of all the different funds and what they're doing and how to invest in them and where to go to find all that. So really grateful that all of you get to join us for this. I know you could spend your Tuesday afternoon or Wednesday afternoon doing a whole bunch of different things. There's a lot of content out there, but we appreciate all the time you spent with us. And until next time, remember, we are each other. Take care now.